Okay, buckle up, because we're about to unveil some mind-blowing insights into the #1 dividend ETF out there. You want to know if it's worth your hard-earned money? Stick around, because you won't believe what we discovered.
You're with Channel Vest. This is your analysis. We're diving deep to give you the ultimate shortcut to being well-informed.
But before we get started, a super important note. This deep dive is for educational purposes only. It is not financial advice. Always consult with a qualified financial advisor before making any investment decisions. All research is conducted by Channel Vest, with a little help from AI tools.
And the data we're using is accurate as of August 22, 2025. Oh, and remember, past performance doesn't guarantee future results, and all investments involve risk. Always.
All right, let's unpack this. We're talking about the Schwab U.S. Dividend Equity ETF, known as Schd. This thing is a titan, with over $71.4 billion in assets. That's insane.
Yeah, it's huge. And what's fascinating here is its current standing, trading at $27.95, boasting a 3.67% dividend yield and an incredibly low 0.06% expense ratio. That really catches the eye.
It really does. But the ultimate question for you, our listener, is it worth your money? We're about to find out, and the results might just shock you.
So let's start with the core idea. What exactly is SCHD trying to do? It's built on a pretty clear investment thesis, designed to bring you specific benefits.
Okay, so what's the game plan? What are those benefits?
If we connect this to the bigger picture, SCHD aims for, well, 3 key things. First, sustainable dividend income. It hones in on companies with a track record of 10-plus consecutive years of dividend payments and strong fundamental metrics.
So they're not just chasing high yields.
Exactly. They're not just chasing yield, they're looking for dependability. They want companies that can actually keep paying and hopefully grow those dividends, less risk of a dividend cut.
Okay, makes sense. And the second point?
Secondly, quality companies. This means exposure to high-quality dividend payers, maybe even some aristocrats in there, but without the potentially higher costs often associated with funds only focused on those super elite long-streak companies.
So quality, but maybe a bit broader, more cost-effective access.
Yeah, you could say that. It's about finding that sweet spot. And third, growth potential. This isn't just about the income stream, right? It's about combining that steady dividend check with the potential for the stock price itself, the capital, to appreciate over time. It's meant to be a holistic approach to building wealth.
Income and growth. Sounds like the ideal combo. But does it actually deliver on these promises? Let's dig into the performance. Keep watching to see the shocking results, because this part's pretty impressive.
Yeah, prepare to be amazed, maybe. SCHD isn't just talking the talk. It seems to be a walking the walk when it comes to performance, historically speaking, at least.
Okay, lay it on us. Proof in the pudding time.
Well, what's fascinating here is its consistent track record on the dividend side. We're talking 13 consecutive years of dividend growth since its inception back in 2011.
13 years.
Yeah.
That's almost unprecedented for a fund like this.
It's a serious commitment to shareholders, yeah. It shows the underlying companies are doing something right.
And get this, an 11.5% 5-year CAGR. That's compound annual dividend growth rate. That's a rate most funds can only dream of.
Right. And if we connect this to the bigger picture, that kind of growth, it really adds up over time. It helps your income potentially outpace inflation, which is crucial. It also boasts a 9.07% 10-year return. That's the total return annualized over the past decade. Pretty solid.
Yeah, a 9% annualized return over 10 years. Many diversified portfolios would be happy with that. So what does this all mean for your potential investment? It means consistent, impressive growth historically. But there's always a twist, isn't there? All right, so the past looks amazing, but what about the present? Even the best funds face headwinds, right?
Yeah.
And SCHD is no exception. We need to talk about the current market challenges.
Yeah, this raises an important question about recent performance. Because SCHD has shown recent underperformance, it's only up about 1.89% year-to-date versus broader market indices, which have done much better recently. That's a notable difference.
Okay, so lagging a bit lately. What else?
And then there's the big one, interest rate pressure, those elevated 10-year Treasury yields. Well, they're creating serious competition from fixed income alternatives.
Right. Why take stock risk if bonds are paying decently?
Exactly. Suddenly, bonds look a little more appealing to some investors, maybe pulling money away from dividend stocks.
Okay. Anything else specific to SCHD?
We also see energy exposure risk. After the March 2025 reconstitution, that's when they rebalanced the index, its energy exposure increased significantly. It's up to 19.2% now.
Whoa, almost 20% in energy.
Yeah, this creates a sensitivity to commodity prices, which, as we know, can be pretty volatile.
Yeah.
Oil prices go up and down. That impacts this fund more now.
Okay, volatility risk there.
Yeah.
But it's not all bad news on the current front.
No, not entirely. SCHD seems to show some trade war resilience. Experts at places like Goldman Sachs and Citi suggest its focus on domestic dividend payers makes it less exposed to tariff risks and global trade spats.
So maybe a bit of a safe haven in certain kinds of storms.
Yeah.
But here's where it gets really interesting. This is insane. Let's peek under the hood. Ever wonder what makes SCHD tick? Its top 10 holdings represent a massive 41.56% of its total assets. So you're not just buying a fund, you're buying a big chunk of these specific companies.
Right. And what's fascinating here is the lineup. The top spots include heavyweights like Altria Group at 4.34%. That's tobacco, a classic dividend payer. Then Chevron at 4.31%, a big energy player. And PepsiCo at 4.30%, a huge consumer staple. Each of those is about $3.1 billion in market value just within this ETF.
Okay, big names. What else is in that top 10?
Then you've got AbbVie, the pharmaceutical giant, at 4.25%, and ConocoPhillips, another energy company, at 4.28%, both around the $3 billion mark, too.
So more healthcare and energy.
Yep. And the rest of the top holdings include Merck, Home Depot, Texas Instruments, Verizon, and Cisco Systems, all holding between, 3.96% and 4.18%. It's a mix, but definitely tilted towards established large-cap companies.
Got it. So if we look beyond the top 10, how does it break down by sector?
Well, if we connect this to the bigger picture, the sector breakdown reveals where your money really goes. Consumer staples makes up 19.5%. Think food, drinks, household goods, stuff people buy even in recessions. Offers stability.
Okay, nearly 20% there. Makes sense for dividends.
Then energy is right there at 19.2%, like we mentioned, due to that 2025 rebalancing. Big exposure. Healthcare accounts for 16.2%, dominated by those big pharma companies with strong dividend histories. And industrials is 11.8%, representing infrastructure, machinery, manufacturing leaders.
Interesting mix. Consumer staples, energy, healthcare, industrials, pretty dominant.
Definitely leans towards those more traditional, value-oriented sectors.
You're the channel vested. This is your analysis. Knowing these underlying components is absolutely key to understanding the fund's behavior, right?
Absolutely. It explains why it performs the way it does in different markets.
Now let's talk about something that directly impacts your wallet fees. And SCHD's expense ratio is insanely low compared to its alternatives.
It really is. This raises an important question about long-term returns, because fees eat away at them over time. SCHD's 1.06% expense ratio is incredibly competitive. If we compare this to other popular ETFs, like VYM, Vanguard's High Dividend Yield ETF, that's 0.12%. SPY, the S&P 500 tracker, is 0.24%. Oh, wait, SPY is 0.09%. My mistake. Maybe thinking older fees. Let's see. SPHD, the Invesco High Dividend Low Volatility one, that's 0.36%.
Okay, so 0.06% versus 0.12% or 0.36%. That difference adds up.
It absolutely does.
That means more money stays in your pocket over time. Seriously, let's put numbers on it. A $100,000 investment compared to that SPHD at 0.36%, you'd save, what, like $300 a year? Over 20 years, compounded.
It's significant.
Yeah.
Using the example from the outline, comparing against higher cost alternatives, it estimates saving approximately $3,200 over 20 years. That's pure savings right there.
That's basically free money staying in your account. You don't want to miss insights like this, do you? Then smash that subscribe button right now. Never miss our financial breakdowns. And hit the notification bell to join the Financial Freedom Squad. It's how you stay ahead.
Definitely worth thinking about those fees.
Okay, let's make this even more real. What if you invested $10,000 in SCHD today? Here's the breakdown.
All right, so at the current price of $27.95, your $10,000 would get you approximately, let's see, 357.78 shares, roughly.
Okay, about 358 shares. What about the income?
Based on its 3.67% yield, your year-one dividend would be around $367, give or take a bit, depending on exact timing and payouts.
Not bad, but here's where the magic of compounding kicks in, right?
Exactly. If we look at its historical performance, that 9.07% annualized 10-year return we mentioned, now remember, past performance is no guarantee.
Right. Disclaimer acknowledged. But hypothetically.
Hypothetically, based on that history, your $10,000 investment could grow to $23,826 in 10 years.
Wow, more than doubled in 10 years, and longer term.
And if you stick around for 20 years, again, using the historical rate, you could be looking at $56,768. That's the power of compounding returns and potentially growing dividends being reinvested.
That's incredible. Nearly 6x your money over 20 years, based on history.
It illustrates the potential, yes. The power of consistent returns and dividend growth working together. However...
This raises an important question.
Uh-oh. Here it comes.
While those numbers are compelling, every investment comes with downsides.
But wait, there's a major risk you need to know about before you even think about investing. You won't believe it. All right, let's pull back the curtain. Time for the reality check. What are the biggest risks you absolutely need to be aware of when considering SCHD?
Okay. First, there are those performance headwinds we touched on. SCHD has landed in the bottom quartile of its Morningstar category over recent periods. While long-term performance is strong, recent times have been challenging for its style. It can lag, sometimes significantly, when growth is in favor.
Okay, so it might underperform in certain market environments. What else?
Then there's sector concentration. That 19.2% energy allocation we mentioned, that creates sensitivity to commodity prices. Big swings in oil could mean big swings in SCHD.
Right, that energy bet. Plus, its general defensive sector bias, less tech, more staples, and healthcare might limit participation when tech stocks are absolutely surging, like they have been at times.
So you might miss out on some big rallies driven by growth sectors.
Potentially, yes. We also have interest rate risk, which we discussed. Rising rates typically create headwinds for dividend stocks, making fixed income more attractive.
So competition from bonds again.
Yeah. Though it's worth noting that SCHD's focus on dividend growth, not just high yield, does offer some inflation protection over time, which can counteract rising rates to a degree. But the initial pressure is usually negative.
Okay, that's a nuance. And finally,
Premium valuation. It trades at a PE ratio of 17.73. Now, that's not crazy high, but it commands a premium compared to some broader market value indices.
meaning it's maybe not cheap.
It means the market recognizes the quality of the companies it holds, which is good, but it could potentially limit its value upside during periods of significant market expansion. It might already be fairly valued or even slightly expensive in some people's view.
Got it. So performance lags, sector concentration, interest rate sensitivity, and maybe not being a bargain buy right now. Those are the key risks.
Those are the main ones to keep in mind, yes.
So what are the big players on Wall Street saying about SCHD? We looked at the experts' opinions to give you a complete picture.
Well, Morningstar, for example, gives it a solid 4-star rating. They actually call it one of the best dividend funds available. High praise.
Really? Even with the recent underperformance?
Yeah, they seem to like the underlying strategy. They mention its sensible, transparent, and risk-conscious approach and believe it should generate better long-term risk-adjusted returns than the Russell 1000 Value Index. They're looking long-term.
Okay, Morningstar's positive. What about investment banks?
Well, Goldman Sachs analysts suggest that SCHD's domestic focus and defensive positioning may provide relative outperformance during periods of trade uncertainty and market volatility.
So back to that shield in stormy times idea.
Kind of, yeah. A potential buffer against global economic hiccups.
Any price targets?
Adding to that, TIP ranks consensus, which aggregates analyst ratings, rates a moderate buy. Their average price target is $30.31.
Okay, $30.31. Where is it trading now? Around $28.
Yeah, $27.95 with the price we noted. So that target indicates about a 10.15% upside potential from current levels, according to that analyst consensus.
So even with recent challenges, the overall outlook from these experts seems cautiously optimistic.
That seems fair to say. Moderate buy, positive long-term views, acknowledging the current headwinds but liking the core strategy.
Want more insights like these? Concise, actionable tips delivered daily. Make sure to follow us for daily financial tips at ChannelVest on all your favorite platforms. We deliver daily market updates, stock picks, and wealth-building strategies directly to you. Stay ahead of the curve.
Good stuff.
And here's a sneak peek. Coming next week, we've got our deep dive research on Tom Lee's ETF. Trust us, you don't want to miss it. Should be very interesting.
Ooh, yeah. Looking forward to that one.
All right, so after all this, after dissecting SCHD from every angle, its growth, its challenges, its risks, its holdings, here's the ultimate question for you. Would you rather invest in SCHD for its steady dividend growth and proven track record? Maybe that defensive tilt. Or are you more inclined to take on more risk with growth stocks, chasing potentially higher but definitely more volatile returns? Drop your answer in the comments below. We'd love to hear your thoughts. Where do you stand?
Yeah, interesting question. And remember, this entire deep dive, everything we talked about, is for educational purposes only. Seriously, always do your own research, dig deeper, and definitely consult with a qualified financial advisor before making any investment decisions. Your financial future is in your hands.
Absolutely. Stay informed, stay smart, and we'll catch you on the next deep dive.